Yanis Varoufakis, and the weak suffer what they must? Europe's crisis and America's economic future. In the gripping book, And the Weak Suffer What They Must? Europe's Crisis and America's Economic Future, Yanis Varoufakis delves deep into the consequences of a common currency without political integration. By analyzing Greece's economic plight and the restrictions imposed by the Maastricht Treaty, Varoufakis dissects the structural flaws of the European Monetary Union. This summary provides an insight into the aggressive lending tactics employed by trade surplus nations like Germany, how the euro currency affected the economies of member countries, and the inherent fault lines of the Maastricht Treaty. As we journey through these critical elements, you'll discover how these factors contribute to the ongoing European Union crisis and its connection to America's economic destiny.
The cost of a common currency. Thucydides's statement comparing the strong and weak serves as a cautionary tale for the consequences of a common currency without political integration, as seen in the Eurozone. The 2008 global financial crisis and resulting credit crunch snowballed, leading to insolvency of banks in European periphery countries. The weak nation's calamities are as much a result of aggressive bank lending by the trade surplus countries as of profligacy in the periphery country. The Maastricht Treaty eschews political surplus recycling, prohibiting fiscal support for social programs, resulting in Greece facing harsh penalties, accepting new loans in amounts insufficient for debt payments. Strain on social obligations includes defunding hospitals and pensions, making Greece's dilemma at the heart of Europe's continuing crisis. The US has played a crucial role in the euro's creation and the European crisis. The future fortunes of the US continue to be linked to Europe's, and the Maastricht Treaty's structural flaws remain as a warning of the cost of a common currency without political integration. The Eurozone's fair-weather recycling. The book explains how fair-weather recycling, the pattern of high-income opportunities and investments flowing to booming periphery countries, has caused trade imbalances and financial vulnerabilities within the Eurozone. These countries, such as Ireland, Spain, and Greece, were lent to by German banks who recycled the euros earned from exports. However, this financial system faltered and the 2008 financial crisis hit, as struggling euro nations had limited response options due to the inflexibility of the euro. The book argues that examining the paradoxical functions of the eurozone and understanding its limitations is crucial to preventing future financial crises. Harsh austerity measures and the Eurozone crisis. How the Eurozone crisis originated from aggressive lending by Northern European banks and the harsh austerity measures imposed on countries such as Greece by ECB, IMF and the European Commission. The Eurozone crisis is often blamed on Southern European countries for their spendthrift ways and lack of fiscal responsibility. However, this view conveniently ignores the role that aggressive lending by Northern European banks played in causing the debt boom. In 2009, German banks alone had a €704 billion exposure to Greek, Irish, Spanish, Portuguese and Italian debtors. The result of the Greek bankruptcy was a real risk of German and French banks going under. To prevent this, Germany and France arranged a loan to Greece in 2010, but it was insufficient to resolve the crisis. The 2012 loan to Greece by purchasing its €100 bonds whose market value had declined to less than €20, earmarked 91% of the loan to repay French and German banks in full. This debt purchase essentially divided the losses among all Eurozone nations, including other periphery states. The loan came with harsh austerity requirements that strong-armed the government into defaulting on promises it made to its people in areas such as pensions and medical care while forcefully discouraging it from defaulting on its bonds and bank debts. The oversight troika comprising the ECB, the International Monetary Fund, IMF, and the European Commission, EC, temporarily suspended bank payments pending the Greek election. Afterward, payments resumed. In 2015, Greece had to accept additional private bank debt of more than €50 million, while its citizens' access to basic necessities deteriorated. The Greek conundrum has its origins in the Maastricht Treaty, which contains a no bailout clause that blocks political surplus recycling from providing for the maintenance of social safety nets and the restructuring of insolvent banks. It stops the ECB from writing down its members' debts and allows no interest rate relief. Further, debtor countries can't default on their bonds. The clause forbids the ECB from making loans to member states' governments or to insolvent banks. Additionally, member nations can't lend to each other. The no bailout clause is unworkable. But in 2010 and 2012, Greece received loans to repay the banks in full. The loans indirectly broke the Maastricht rules by having Greece sign IOUs that were passed along to the ECB. The IOUs come from the European Financial Stability Facility, an entity that can issue bonds to raise money for failing Eurozone members. The Troika bent the rules only so far as to provide just enough liquidity in order to repay the ECB and IMF. Otherwise, it imposed severe austerity on distressed countries amounting to the dismantling of basic social welfare provisions. The austerity rules were not bent to help the people of Greece. Thus the Greek crisis spread to Ireland, Portugal, Spain, and Italy. In conclusion, the Eurozone crisis originated from aggressive lending by Northern European banks and the harsh austerity measures imposed on countries such as Greece by the Troika. The Maastricht Treaty's no bailout clause is unworkable, but the loans received by Greece broke the Maastricht rules and came with draconian austerity requirements. The failure to consider the ROI of helping the people of Greece has led to the spreading of the Greek crisis. The flaws of the Eurozone. The Maastricht Treaty in 1992 highlighted the need for a comprehensive political union alongside the monetary union that would ensure surplus transfers and bank debt restructuring. François Mitterrand and Helmut Kohl, who were instrumental in creating the euro, understood that a major crisis would spur further political union, but unfortunately, greater integration didn't happen during the 2008 crisis. The animosity sparked by the ECB's actions following the Great Recession also made closer political and banking union less likely. There is a noticeable lack of the desire for further political union among euro institutions officials. The EU intended to take politics out of common rules and industry standards in trade agreements, but the EU and the European Council share officials. ECB technocrats and Maastricht's strict austerity policies encourage authoritarianism and led to the rise of far-right political parties across Europe. In summary, Europe must either integrate further as a political union or dissolve, but Eurozone's officials are doing everything in their collective power to avoid moves towards federation. The flawed architecture of the Eurozone. The European monetarily unified nations are struggling with the Eurozone crisis that comprises four principal factors. These include the global financial collapse in 2008, impractical no bailout law of Maastricht, decreased investment within Europe, especially trade deficit countries, and societal breakdown attributed to austerity measures impacting access to basic human services. The core issue with the Eurozone is that it features states without central banks, a monetary unit that acts like a gold standard, and a European central bank without a guardian state. The need for European monetary union arose due to the Nixon shock in 1971, which caused then-President Richard Nixon to upset the dollar-based global currency order. After years of discussions, the Maastricht Treaty created a monetary union, but its structure had severe, inflexible fault lines. Similar to the Bretton Woods system, the euro is a fixed exchange rate regime. The treaty has an impractical no bailout article, intended to prevent governments from being troubled but ultimately causing problems in member nations' economic reinvestment and debt forgiveness. Until 2008, Wall Street traded derivative deals by taking in massive daily foreign capital inflows. The US served as the vendor-financed partner of European countries, and cash from Europeans such as Germany circulated back to European private banks through Wall Street. However, Europe lost the surplus recycling circuit after the 2008 Wall Street crash when the US could no longer cushion the euro's underlying fracture lines. The Eurozone crisis intersects with similar economic struggles in America and China. Both nations are working to address the financial downturn with fiscal and monetary policies. However, Germany's export surplus and caution in internal inflation and consumption, combined with strict austerity measures enforced on peripheral countries, may cause more significant recessions rather than healing them.
Yanis Varoufakis convincingly unveils the root causes of Europe's financial distress and its far-reaching implications. Through an in-depth exploration of the Maastricht Treaty's inherent flaws, the devastating effects of a monetary union lacking political integration, and the aggressive lending patterns of trade surplus countries, we come to understand the deeper implications of Greece's economic turmoil, the link between the EU and American economic trajectory, and potential consequences for the region's future. As Europe stands at a crossroads, the need for closer political and banking unions becomes evidently clear. By grappling with these complex issues and their significance, and the weak suffer what they must, enlightens us on the interconnectedness of economic policies and the potential impacts on our collective future.